The crypto bull market is almost upon us, and you need to be prepared. That means picking the coins and tokens that will maximize your gains while minimizing your pain. This involves creating a robust crypto portfolio that balances the incredible risks and rewards that crypto has to offer. A crypto portfolio that you can actually keep track of and understand. Today's video will give you a step-by-step guide on how to create the ultimate crypto portfolio so that you can make the most of what is likely to be the biggest bull market you'll ever see in your lifetime. My name is Guy, and you're watching The Coin Bureau. I'll start by saying that nothing in this video is financial advice. It's purely educational content that's meant to assist you on your crypto quest. You should also know that Coin Bureau team members hold a few of the cryptos mentioned in this video as part of our personal portfolios. I'll point them out as we go along. If you want to know what our full crypto portfolios look like and which cryptos we're considering adding to them, then head on over to the Coin Bureau Club. It's our new subscription service which provides actionable crypto market alpha and in-depth reviews of small cap altcoins voted on by our members. Yes, you heard that right. Unbiased, in-depth reviews of small cap altcoins voted on by you, if you become a member. The first 1,000 members will be given an exclusive deal, so hurry on over and become a member of the Coin Bureau Club by using the link in the description. Now, with all that said, the first step to creating the ultimate crypto portfolio is to understand the risks and rewards associated with every coin and token on the market. In theory, this requires analyzing every crypto in detail. In practice, though, all you need to do is understand the different crypto categories. In this context, crypto can be categorized as being either large caps, medium caps, or small caps. So, for context, large cap means a market capitalization of more than $1 billion. Mid cap means less than 1 billion but more than 100 million. And small cap means less than 100 million. Now, this is up for debate, but let's stick with it. And in case you're wondering, a crypto's market cap is calculated by multiplying the number of coins or tokens in circulation by the price of that coin or token. This information can be easily found on coin tracking websites like CoinMarketCap and CoinGecko, and it's the main thing you need to look at. As a rule of thumb, large cap cryptos are low risk, low reward. That's because large cap cryptos have typically been around for a long time and have established themselves as the top players in their respective niches. However, that means that most of the gains have been made, relatively speaking. So, for example, Bitcoin's BTC is the largest by market cap. That's because it's been around the longest and has conquered the store of value niche. BTC's large market cap means it takes a lot of money to push its price up or down. This is good if you want to minimize risk, but it's bad if you want to maximize gains. By contrast, small cap cryptos are high risk, high reward. That's because most small cap cryptos tend to be new and haven't yet established themselves as serious competitors in their respective niches. These are the kinds of cryptos that could go to zero or could go up by 100x or more. That's simply because a small market cap means that it doesn't take much money to push its price up or down. This is good if you want to maximize reward, but bad if you want to minimize risk. So, logically, mid-cap cryptos are in the middle. They're recognized but not established and can still see decent gains. Before I break down how you can structure your crypto portfolio to get the best of all three worlds, you need to know about a fourth crypto category, and that's stablecoins. FYI, stablecoins don't just include tokens pegged to fiat currencies like the USD. They also include tokens pegged to commodities like gold. Now, believe it or not, but stablecoins come with risk and reward profiles of their own. Most stablecoins are centralized, meaning that they can be frozen at any time. Most stablecoins are also backed by volatile assets such as US government debt or kept in money held at banks that could potentially go under. For stablecoins backed by commodities, the biggest risk is regular volatility. The price of gold goes up and down over time, which may not be ideal if you're trying to use it as a place to park your gains. As you'll see though, stablecoins can be extremely useful despite their not-so-obvious downsides. And by the way, if you're enjoying the video so far, be sure to smash that like button to help others find it. Now that you understand large caps, mid caps, small caps, and stablecoins, the second step is to start choosing a few cryptos from each category that you want to add to your portfolio. Unless you work full-time in crypto, it's unwise to have more than a dozen cryptos in total, because you just won't be able to keep up. Naturally, this means no more than 3 to 4 cryptos per category. The caveat is that the allocation ultimately depends on your personal risk tolerance. If you're young, have no debt, or are only investing using money you can afford to lose, then you should consider accumulating more mid-caps and small caps. Conversely, if you're older, have lots of debt, and are investing money that you should probably be spending on other things, then you should consider accumulating more large caps. Not financial advice, but if you do fit this profile, you should probably spend that money on paying your bills and debts. If you happen to be sitting on massive amounts of money already, then you should actually consider accumulating stablecoins. I'll explain why a little later. Now, this begs the question of exactly which cryptos you should consider adding to each category of your crypto portfolio. The answer has less to do with the coins or tokens themselves and more to do with the niches that they fall into. Recall that Bitcoin's BTC is basically the only store of value crypto. If having a store of value is something that's important to you, then BTC should probably be part of your large cap allocation. I should note that every member of the Coin Bureau team holds BTC as part of their crypto portfolio, but this probably won't come as a surprise. Most people in crypto hold BTC. What may come as a surprise, however, is the realization that almost all the other cryptos in existence are either built on Ethereum or are trying to compete with Ethereum. This makes ETH another logical addition to the large cap allocation, and it's a big part of why most of the Coin Bureau team holds ETH too. However, some would argue that ETH's risk-to-reward profile isn't nearly as good as other large cap cryptos. That's just because ETH is the second largest by market cap, and it's constantly facing competition from large cap competitors with smaller market caps like Cardano and Solana. If you step back though, you'll notice that these cryptos all have something in common. They're all smart contract cryptocurrencies. Now, smart contract cryptos are essentially the backbone of the entire crypto ecosystem. If this is something you value, then you should consider these for your remaining large cap allocations. Again, deciding on these allocations should have less to do with the specific coins or tokens and more to do with the categories they fall into. If you find a large cap crypto interesting, ask yourself why and see whether there are any other crypto projects in that niche that could take some of that market share. This allows you to simultaneously protect against the risk that the specific crypto project you choose underperforms and increase the reward if that crypto niche takes off. That's because you'd be holding one of the alternatives and because the coins and tokens in the same niche tend to rally together. This ties into the mid-cap crypto allocation, which is similarly straightforward. If you look at most mid-cap cryptos, you'll notice that they tend to be utility tokens of some kind. In other words, they're used to power a use case like on-chain data gathering or power a protocol like a decentralized exchange. Like the large-cap allocation, you want to think less about the coins and tokens and more about the use cases when choosing your mid-cap allocations. Unlike the large-cap allocation, you need to pay extra close attention to tokenomics because mid-cap cryptos tend to be tokens, not coins. For reference, coins are the native currencies of crypto blockchains, meaning that they're used to pay for transaction fees. So, for example, BTC is Bitcoin's native crypto coin and is needed to pay for fees on the Bitcoin network. This is significant because it means using the blockchain requires that coin. Fees create organic demand. By contrast, tokens are not native currencies of blockchains, and they often have no organic demand drivers. This is an issue that many DeFi protocols currently have. All their tokens grant governance rights, but don't capture any of the fees their protocols generate. At first glance, they don't make much sense. But if you watched our video about which crypto niches to watch for the next bull market, you'll know that DeFi was one of them. That's because it's theoretically possible for these protocols to change their tokenomics so that they do capture this value. The only thing standing in the way is regulatory uncertainty. This is especially true when it comes to tokens belonging to decentralized stablecoin protocols, which, in our opinion, could become some of the most valuable. Take a second to consider that creating a robust decentralized stablecoin is the holy grail of crypto. It would be creating an actual digital currency. This is probably why some DeFi protocols, such as Aave, have introduced their own decentralized stablecoins, and it's why their governance tokens would be logical mid-cap allocations. The price action of MakerDAO's Maker token foreshadows what we could see for Aave and other such governance tokens. But again, the problem is regulation, and this is something else you need to keep in mind when it comes to these tokens. Many tokens could be classified as securities, unregistered stocks in shady offshore companies. This comes with a whole other set of risks that aren't always regulatory in nature. That's why many of the Coin Bureau team prefer to stick to coins with specific use cases for their mid-cap allocations. Funnily enough, most of these coins can be found in the Cosmos ecosystem. That's because Cosmos's philosophy is that the most popular dApps will require their own blockchains. I should note at this point that Cosmos's Atom coin is in my personal portfolio. Anyway, take Injective Protocol for instance. Injective is a derivatives DEX that lives on its own blockchain. That means there's a demand for INJ to pay for fees in addition to all the other demand drivers related to the DEX. As a result, INJ is one of the few cryptos that's rallied close to its previous highs in the bear market. Mid-cap cryptos with this kind of profile are arguably the best ones to accumulate, and you'll notice that they all fall into a much broader niche which could be described as infrastructure. Decentralized stablecoins, DEXs, liquid staking protocols, and others are all fundamentally crypto infrastructure. Now, the only tricky part about picking mid-caps is that there's lots of them, and it's not always easy to know which use cases will see demand, or when, or for how long. The trade-off of this increased risk is a higher reward. And this relates to the small-cap crypto allocation, which is like the mid-cap allocation, but on steroids. That's because the name of the game for small caps is speculation. Coins and tokens that have market caps of 100 million or less are often still in development, and therefore often don't have any actual demand drivers beyond the speculation that demand drivers could someday materialize. If you watched our video about when to accumulate altcoins, you'll know that the most speculative altcoins are those that seek to disrupt the current leaders in the biggest crypto niches and use cases. This means cryptos that are looking to become bigger than the likes of Bitcoin or Ethereum or Aave. Although it's objectively unlikely that a crypto as big as Bitcoin or Ethereum will be taken down by a small cap at this point in crypto's evolution, the small possibility alone often causes massive gains to be made, even if this mission is never achieved. Some large-cap smart contract cryptos are good examples, not naming names, of course. Now, whereas the trick to allocating to large caps is to focus on the niches, and the trick to allocating to mid caps is to focus on the use cases, the trick to allocating to small caps is to focus on the narrative. Meme coins are the perfect examples here. These cryptos literally pumped because they were memes. If you look at all these meme coins, you'll note that they likewise have something in common, and that's an abnormally small sticker price. The apparently low price of these cryptos often gives the impression that they could pump, and they often do, even when the market cap would tell you that they shouldn't. Remember that it's the market cap that matters. Bigger market cap, smaller gains in percentage terms. As we've mentioned many times before, this is something that the average retail investor doesn't understand, and the result is that the most speculative small cap coins can continue to pump even when they become unsustainably large by market cap. This means that you must think like a retail investor. In practical terms, this means asking yourself which small cap cryptos could be marketed in a way that would result in a retail frenzy. This is, of course, easier said than done, which is exactly why we created the Coin Bureau Club. Because I can tell you right now that we've come across a few small caps that do meet this criterion. And remember that there's an exclusive deal for the first 1,000 members in the description. Now, shilling aside, the main thing to remember about accumulating small caps is that they are probably very temporary investments. Often, they'll go up by 10 to 100x in a short period of time, crash, and eventually drift down to zero. When you see the retail coming in, that means it's time to get out. Assuming you've made some profits, then it would be wise to rotate them into your most promising large caps and mid caps and use the initial investment to fish for other small caps that could pump because of an insane narrative. The last thing you want to do is fall for the narrative on a small cap. And this brings us to the third step for creating the ultimate crypto portfolio, and that's your stablecoin allocation. As with your large cap, mid cap, and small cap allocations, your stablecoin allocation should be diversified. This is partly because there's currently lots of regulatory uncertainty around stablecoins. It's also partly because different stablecoins have different attributes. As you'll recall, not all stablecoins are pegged to fiat currencies like the USD. Some are pegged to commodities like gold. And that's just the tip of the iceberg. Due to their on-chain nature, there's a lot you can do with stablecoins. Lending out stablecoins on borrowing protocols or providing liquidity for stablecoin pairs on DEXs is a great way to earn a passive income on your profits while you wait to invest in other cryptos. Some stablecoins allow you to earn yield directly from the assets backing them. You'll have to DYOR there. To put things into perspective, sometimes yields on lending stablecoins and yields on providing liquidity can be as high as 10 to 20%. This can be very lucrative in real terms if you're already sitting on a lot of money. While it's true that these yields are temporary, there are protocols that can help find new yield opportunities. And another thing you can do with stablecoins is use them as collateral for loans in borrowing protocols. This can allow you to invest in other cryptos you want to accumulate without having to sell your stablecoins. Note that you can often do the same with smart contract cryptos. Just remember, they're very volatile. Now, regarding which stablecoins you should consider, each one comes with its own pros and cons. Some people prefer Paxos's USDP because it's technically the most regulated. The problem with USDP, though, is that it isn't as widely supported, so there's not much you can do with it on-chain or off-chain, at least not yet. Others prefer Circle's USDC because it's the most used in DeFi. If you want to do any of the use cases I just mentioned, then chances are you'll be using USDC in some way, shape, or form. The problem, though, with USDC is that it isn't supported by too many exchanges, and it's also allied with some controversial entities. That's why most people seem to prefer Tether's USDT. It has a decent amount of DeFi support, is supported by many crypto exchanges, and is true to crypto, so to speak. The trade-off with USDT is Tether's relative lack of transparency and the ongoing regulatory scrutiny it has received because of it being based offshore. Now, in recent months, we've also seen new stablecoins emerge, such as PayPal's PYUSD, which was issued with the help of Paxos. It's too soon to say what advantages these stablecoins will have, but in the case of PYUSD, it's possible that it will emerge as the easiest to use for everyday transactions, payments, etc. And finally, we have the commodity stablecoins, most of which are backed by precious metals, mainly gold. Like fiat stablecoins, gold-backed stablecoins come with different levels of transparency and redeemability. For now, Paxos's PaxG appears to be the biggest by a wide margin. Besides volatility, the problem with gold-backed stablecoins is that they aren't supported by DeFi protocols and have limited exchange support too. This is a bit odd considering that many in the crypto industry are fans of the gold standard, and it could theoretically be recreated by using a token like PaxG in DeFi. In any case, No matter how you decide to structure your large cap, mid cap, small cap, and stablecoin allocations, remember that you must keep any coins and tokens you're not actively trading in your own personal crypto wallet. Ideally, you'll use a cold wallet such as a hardware wallet for maximum security. If you want to get a discount on some of the best hardware wallets, be sure to check out the Coin Bureau deals page. It also has up to $40,000 of bonuses and the biggest trading fee discounts on the best crypto exchanges, exclusively for the viewers of this channel. So be sure to check that out in the description. So that's all for today's video, folks. If you found it helpful, then smash that like button. If you want to keep getting more helpful content, subscribe to the channel and ping that notification bell. If you want to help others, consider sharing this video with them, if it's appropriate, of course. As always, thank you all for watching, and I'll see you in the next one. This is Guy, signing off.